Hello everyone. This is a breakdown of a model that I created to underwrite multifamily projects. So here we do have the contents in the model. We do have the executive summary all the way to the tax analysis. And I wanted to give you a short description of each and every tab so that now at least you can be able to see the kind of model that I usually use to underwrite multifamily development projects. So the next tab we do have is the investment summary. So this is a highlight of the key outputs of the financial model that has been displayed here, and it's a printable worksheet. As you can be able to see, we do have the property information, we have the sources and the uses. We do have some charts on this other side. We do have for the sources and for the uses, debt and equity, and all as now the total uses components. We also have sales assumptions. We do have also residential, because this one assumes that you're going to have both for sale as well as for rent kind of project. Yeah, so it's more of a detailed multifamily project. So we do have for the rentals, we do have this section which outlines here the total annual rent and the monthly rent here. Also have, because it's a mixed use as well, on the ground we do have a section where you do have the retail section. As you can see here, the tabulation, the annual rent you expect to receive. We do also have hospitality included in the model. As you can see here, we do have the number of keys, total square foot, and also the annual income expected. And we also have the annual daily rate indicated on that section. So here we do have the total rentable square feet and the gross square feet of the property. We also have now the breakdown of the cash flows from the first year all the way to the 10th year. And also we have the net operating income, income tax, the unlevered cash on cash. So here we do have the terminal cash flows indicated, the sales proceeds based on a cap rate, the sales cost. We also have now below the debt financing component here, or the refinancing cash out that you expect to receive upon refinancing at the end of the at exit. We also have the balances for the debt as well as for the equity that has been invested from the time zero. So here below we do have the leveraged cash on cash, the bottom here. So here we do have the key highlights from the net operating income to the debt service coverage ratio. We also have the return summary with the IRR indicated. We also have the equity multiples. We have the yield on cost expected. And here we do have, since we're going to do a waterfall, we do have partnership returns for the LP as well as now for the GP. So the next section we do have the underwriting assumptions. So these are the assumptions that have been used to be able to drive the model. We have the program assumptions for the efficiency factor. We have the investment assumptions, the investment analysis period. We do have the financial assumptions, this for the debt, the terms for the construction loan, as well as now the terms for the permanent loan. We also have the valuation assumptions, the cap rate that has been used in the terminal cash flows. We also have the property valuation from the 3rd year all the way to the 10th year indicated there. We do have the revenue assumptions. So here we do have the underwriting rents that have been used in underwriting the project for the sales, for the rental, and for the hospitality, the ADR. You can be able to see each and every component has been highlighted. We also have the OPEX assumptions for the office, the retail office. These are the operating expense for each category listed as a percentage of the effective gross income. We also have the hospitality. These are the assumptions that have been used for the annual bumps, the vacancy and credit losses, the room expenses, and the total expenses. So these are the annual growth for the income and expenses. And here we do have the equity waterfall structure for the LP and the GP. And these are the breakdown of the promote, as well as now the hurdle rates, as well as now the investment structure. So here I do have the breakdown of the equity waterfall. As you can see here, we do have the partnership structure indicated. We do have also the cash flows now coming from the annual cash flows that have been derived from the project. You can see here we do have the splits from the first hurdle all the way to the fourth hurdle. And then we do have a different, in case we don't do a waterfall, we can say that we do a split based on the committed capital. We can be able to have a such section for that, so that now you can be able to see what the GP and the LP will do now to get. So we do have the final cash flow, which now goes now to the investment summary presentation. We do have the partnership returns. So here we do have also a discounted cash flow analysis, as you can be able to see, and that the assumptions indicated, the going in cap rate. This is a sample project that I'm using to showcase this model. You can see here all the way we do have now the cash flows from the year 1 or year 0, sorry, to year 10. You can see there. Yeah, all the way up to year 15. So this one goes up to year 15. The template goes up to year 16, but now we do have cash flows going up all the way up to year 10 for this project, and these are the terminal cash flows. We also have the risk, and also we do have a DCF valuation indicated here. We also have the project IRR matrix, which shows the kind of returns that will be earned for the project from year 1 all the way up to year 10. Able to see the kind of IRRs we're supposed to earn for each and every period. We'll also have the NPV, net present value matrix, which is levered. We have the NPV for each and every year. So if the investor wants to exit at year 1 or after year 3, you can see this is what will be attained. Up to year 5, this is what will be attained. At year 8, this is the NPV that will be attained. We also have now the unlevered or the unleveraged IRR matrix. You can see these are the kind of returns that will be earned based on unlevered basis from the 3rd year. Yeah, you can be able to see how it progresses depending on the exit year of the investment. Also, we do have for the NPV as well, unleveraged. We do have that breakdown indicated here below. So here we do have the annual cash flows, which now based on the operations of the property. You can see here we do have from the year 0, the pre-construction, all the way to operations up to year 16. But now this project has all the cash flows up to year 11 or year 10, the analysis period. So year 11 will be the residual year. So we do have the residential multifamily. These are the cash flows that will be earned. We do also have the residential for the condos. These are the expected sales incomes after construction. We do also have the retail component. So this is the expected annual cash flows that will be earned and how they grow from year to year. So these are the operating expenses for each and every year. You can see this is for the total. So you can see the net operating income coming from the residential as well as the retail component. On this section, we do have the hospitality. So these are the incomes that you expect to earn. This is the gross income. We do have the total operating income, and this is the total cost of goods sold. We have the effective gross income. So these are the expenses coming from the hospitality section. So this is the expected EBITDA for the hospitality. So the net operating income consolidated carrying both the hospitality, the retail, as well as the residential components is brought down here below. You can see that's the section. So here you do have the levered net operating. Sorry, let me just take you through the sales process, the capital items. We do have the sales proceeds expected. We do have the selling costs that will be incurred upon exit. You can see here below. This is only based on the cap rate that has been selected. It is 6%. selling costs. We have a capital transaction fee. We have the tax on capital gain that's also illustrated on this workbook. I also have the not operating. So here we do have the cash flow before debt service and tax coming here. We also have now the levered net operating income after adjusting. We do have now what we expect to get. So we do have now the financing section. We have the PAM loan. These are the interest that will be paid and the principal as well. So cash flow after financing is a resultant figure here. You can be able to see on this line. We also have now the capital items. We have the asset management fee. We do have the sales proceeds. We do have the selling cost, the capital transaction fee, as well as now tax on capital gain. So this one assumes this is based on unlevered, and this one is based on a levered basis. So we do have the cash flow. We do have the income tax also computed within the workbook. So here we do have the cash flow after tax on this section. So here is the investment, and here is now the net income. So we do have now the cash on cash return and the debt service coverage ratio computed on this section. So here we do have now the unlevered IRR being computed here, and the levered. Can be able to see the breakdown. And here we do have also a valuation summary and shows the value creation, and also you do have the property valuation indicated. So here we do have now the combined monthly cash flow. So this is now because this one was based on the annual. So here we do have now based on the monthly. You can see here how it now tabulates. How it tabulates from month 0 all the way to the month should be month 132. Yeah, 132, because this one now the last 12 months will be now for the residual. So the analysis period is up to month 120. You can see, so these are actually the incomes that you expect to get. So here is the construction from month 0 all the way to month 24. 2 years is the construction period. So these are now the cash outflows and the sales income that you expect to get. So here we don't expect income, so we just have zeros. So after construction, that's when you have the cash flow coming in. As you can see here for the retail, similarly, also hospitality, similarly, you don't have any cash flows coming in all the way up to the month 25 when cash flows come in. So here below we do have now the net, the consolidated cash flows for each and for the total components. We do have now for the financing. You can see the PAM loan for the debt component. We do have the cash flow after financing here. We also have now, in case we do have a refinancing cash outflow, is indicated here. Yeah, for this project we didn't have after refinancing the project after completion. So here is the cash flow after debt service before tax is indicated here. So the tax is calculated on an annual basis, which comes on this side, on this tab. So these are the equity and debt cash flow section. We have the residential rent calculation. This is where we calculate the rents for the residential section. We also have the sales. This is where we calculate the sales. So here we also have the loan amortization table for the construction loan as well as for the permanent loan. So here is the property property input. So these are the input section. You can see here is when where we indicate the details of the project. I can see that's where we detail everything. Yep. We also have now the purchase section, which shows you the purchase costs, the after repair value. I also have the total funding required. So these are the total closing costs. If it's a purchase, then rehab of the development project. We also have now, this is the investment cash flow, the development budget input. We do have the sources and uses. So we do have the land costs, as you people can see. So we do have tabulation for the land, each and every item for the land costs. We do have existing value. We have the acquisition, we have the building acquisition, if it's an acquisition of the building. We have the ground lease, if you're going to have a ground lease. We have the land, which is the offsite. We have an offsite portion next to the property. We also have the pre-development and entitlement costs here, and the demolition costs here. So the forecast method also we do have based on, we can do either a straight line, S-curve, or we can be able to do a detailed. Let me just type. So these are the three options which now can be able now to be altered here, and this now will be able to be carried on the monthly cash flow schedule, which is now next to the cost detailed budget. So we have the land costs, we have the site preparation, development development costs. We also have the hard costs. We also have the pre-development costs indicated here below. We also have the soft costs. We have the development contingencies. We have the carry costs, and we have the fees, and we have also have now the total cost after financing. So this is the total development budget. It's tabulated here below. You can see these are for the monthly. Here we do have now the financing input section. Here we have the assumptions that have been used. So here we have a senior loan. You can select between a senior loan, 100% equity, construction loan, permanent loan. Then we could go to the cap, what the lender uses to cap the loan. So you do have, it's a redevelopment loan. We also have, if it is based on LTV or debt service coverage ratio, you can be able to select. So you can say what is the LTV ratio that lender will be able to use, 70%, which is the minimum debt service coverage ratio that will be used, 1.2, and the maximum LTV should be 70% for this project. So we do have now the construction loan. So that on these assumptions now drive what will now be the loan amounts that will be calculated on this section. So here is the loan principal calculation section. So if it's based on the LTV, you can see the purchase price. There's no purchase. These are total development. These are ground up development project. You can see here we do have the total development cost based on the total budget here. That's the total development cost minus the interest financing costs. So you can be able to see it is there. Then you have the loan principal on that section. So this now, if it's based on 70% LTV, this is what the loan amount that should be provided. If it's based on debt service coverage ratio, then we'll have to now come here and be able to select. Then you have to ensure that the NOI, so that now you can be able to calculate properly. So that now you can be able to get the loan maximum loan amount, because this one is not fed into the analysis. So you do have a loan there. So here is the principal loan amount after financing, because we do have now the financing cost. We do have the origination points of the financing fee. These are the other costs paid to the lender, and also this is the total financing cost. Now, if they are rolled into the loan, so this is the total loan amount. So the equity required will be this amount here. So these are the for the permanent loan. These are the assumptions. This is the breakdown of the permanent loan section from the LTV to the time the permanent loan should be able to kick in after now construction. So here are also the terms, the loan principal amount that will now be borrowed to at the end of the period. So this is the LTV amount, 70%. Also here above is the term, the start date and the end date also indicated. We also have the cost of the refinance, the interest for during the refinancing to the permanent loan at conversion. So we have the fees here. I also have the other costs paid to the lender. So these are the total financing costs. They are rolled into the loan. So you can be able to select if they're rolled into the loan or paid at closing. And that one I have to confirm while giving me a reference. So I need to check that. So you also have the loan including financing costs. We have the equity basis after the PAM loan. So these are the calculation of the loan principal and the PAM for the permanent loan. So here I'll take you through the equity contributions for the investor. For the waterfall section, you do have the investor, the sponsor, as well as the investor. For this equity amount that we indicated here, 10.7. So we do have that amount. So we do have the sponsor contributing 18.2 and the investor at 81.8. So these are the breakdown. So here I do have, if it's a preferred return, indicate it's a yes. If it's a no, we don't indicate there's no preferred return. So here we do also have a single and a double promote structure. Yes, so this one is a single. Then you have the waterfall section for the investors, the LPs, and the sponsor, the GPs. So this is a preferred return structure. So this is the first waterfall partnership level. These are the hurdle rates. This will indicate the hurdle rate. These are the for the promote, because the promote does not, if you do not have a promote, leave it at 0 for the first hurdle. For the second hurdle, these are the hurdle, that's the hurdle rate. This is the promote for the second hurdle. The third hurdle, this is the this is the target IRR, target hurdle rate, or rather, we do have also the promote. So distribution based on this ratio, we do have that distribution. This is the hurdle for the hurdle 4. We do have the target IRR, and this is the promote, and this is the distribution at the end. So if it's a double, we do also have the GP and the co-GP. Yeah, so we do have that. I do have the total sponsored. So this one, 1.956, is based on what the GP is contributing. So we can have a GP and a co-GP. Then you do have the aeration. Then if it's because this one is the GP is not contributing anything, it's totally the co-GP. Then you can also say this one is 10%. So we have 10 and 90. So you have the GP contributing, and you also have the code GP, at least to align interests. So these are the hurdle rates. There's no ratio indicated here. So you can be able now to alter and be able now to say if there's a preferred, say 10% here. There's no promote. So GP is 50%. Is only 50%. You can say here the second hurdle for the preferred is 15%. 15%. So let me say 12%. There's no promote. So it is 1090. Yeah, based on the investment, there's no change because you don't have a promote. If I was to say 20%, you can see the ratio will be able now to change based on the promote. So all this will now be able to affect the waterfall distribution. So we do also have, if I were to say this one 15%, and the promote is 0, 1090. You also have the, let's say this one should be 20%. Then distribution should be 1090. You don't have a promote for this section. All the way up to 105 you need to. Yeah, these are now the deal sponsor logic input. So here, if in case we are paying for the a sponsor fee like to the GP. So here we do have if we're going to pay, because the distribution is 18.2. So if there's an acquisition fee or purchase price, we indicate here the asset capital Asset management fee we indicate here. We also have, in case we do have a capital transaction fee, we'll be able to, can be able to indicate there. So here below we do have the total sponsor compensation on an annual basis. So these are the input section for the hospitality. For the revenues section, so you can see how we generate the room revenue based on the ADR, converted now to on a per square foot basis. Can be able to see we converted the ADR to rate per square foot per year to drive the income. You can see the total square feet and the number of keys. We can see here we do have the vacancy section and the credit loss, which is netted against the total revenue. I also have now the specific revenue items. We do have the room revenue is the first one. We also have the catering revenue. We also have the release revenue. Both of these two items, the three items will not give us the total operating income. Then we do have the cost of goods sold netted against the total, which is now around 10% estimated. You can be able to see that will be the total cost of goods sold. So the effective gross revenue will be that much. We do have the expenses totaling to this much for the total for the operations of the hospitality section. We do have any allowances for furniture, fixtures, and equipment. We do have, you can indicate if it's 2% or 3% or 5%. To be able to indicate there, then you can be able to deduct there in case for this one we didn't have any. So these are the hotel rate summary. So that's for the rooms. We do have the, in case we do have a meeting revenue, we do have catering revenue, and also have rooftop bar revenue. Yeah, so this one is based on the specifics of the hospitality complex. So here we do also have the retail section. These are for the revenues. This is the best rental income. I can see for the retail space, this is a tenant indicated. This is a lease start date, the square feet that the tenant has leased. And this is the rent per square foot per year. And this is the total rent for year one. If they're professional office suites, we can be able to indicate what will be the total rent income. In case we do have any recovery income, we can be able to specify the percentage and can be able to be tabulated here. So we do have the effective gross revenue after deducting the vacancy losses. We have it there. We also have now retail operating expenses. So here we can be able to indicate the specific percentages and can be able to be computed there. So we have the retail income net of expenses comes there. So we have also in case the leasing cost that will be incurred, we can be able to specify and can be able to get the total. So this is the retail rent summary for the retail space and for the professional office suites. You can see that this is the total net rentable area. This is the percentage of occupancy for these spaces. This is square feet occupied. Yeah, you can be able to see this is the in place in case because this one is a ground up development. We don't have any in place. This is a market rent per square foot. You can be able to see it's indicated there. This is a target rent. We haven't indicated any assumptions for this. So in case of any other rent income expected, so the underwriting rent will be the market rent, because we're going to underwrite against the market rent, and we can be able to specify on this section. Yes, on this section, so you can be able to specify which rents we are going to underwrite the project to. So the sections for that selection. Yeah, so that's underwriting rent for the retail. You can be able to see the monthly rental income, total annual underwriting rental income, variance to in-place rent in case we do have a variance. So these are the rent collection percentages. So for the condos, these are the rental for the sales income projection. Sorry. So we do have different unit types. We have 2 beds and 3 beds. So these are 20 units in total. Then you can be able to see the split between the 2 and the 3 beds, the unit sizes. We also have the total built-up area. So these are the revenues for the sales prices. We're going to sell at $116 per square foot. So this is what to expect to get for the 2 beds and for the 3 beds. The deposit will be 10%. This is what will be payable for the 2 and the 3 beds respectively. So you also have the expected income. This is the total income after total sales at the end of the project. Yeah, so this is what we should expect after 2 or 3 years after, depending on the sales period. For the residential rents, so these are the section, these are rent roll that we built. So this one is based on a projection forecast. You can see here we do have the assumptions for the rental income. So the operations begin period, the operations begin date, the lease contract length, which is a month, total rentable units, which is the development program 70. So you'll be able to see in case of any assumption for the stabilized vacancy, can be going to indicate here. I do also have now the market rent growth section here. So these are the summary of the in place market rents, other rents, and the target rents. So maybe this will not calculate the market rent headroom for increases. This for increase in case we need to increase. If the underwriting rent is below the market rent, you can be able now to see what the headroom for rent increase. So that now you can be able to optimally analyze or underwrite the project. Here we do also have, because it's a new construction, you can be able to see here section, you can be able to select which rents we're going to underwrite the project to. Here we've selected market rents, you can be able to change and be able to see if it's going to be in place or based on target rents or other rents or the market. So here is the current unit summary. We have studios, we do have 1 beds, we do have two beds. So these are the numbers, the units, the split, the unit mixes, the occupancy, the square feet for each and every unit. So you can be able to see the tabulation, the 70, the total number of units. We also have the underwriting rents. We also have the total monthly rental income, the annual income. These are the underwriting rents. So on this section, you do have the total annual rental income indicated there. So there's a rent contribution. So the variances. So here you do also have the lease up schedule. After completion, month 25, we expect to have 20 units leased. Month 26, 30 units leased. Month 27, 20 units leased. So at month 28, everything will be leased out. So these are the total number of units. Can be able to see the percentage of vacancy goes down. Yes. So here we do also have the operating expenses schedule. So this way you can be able to indicate the operating expenses that you expect to incur for the residential section. You can see there's no renovation, there's a development, ground up development. So there's no rental income during renovation as well, during development. So we do have the property management fee, what percentage that should be paid to the property manager. The asset management fee, this what will be paid to the sponsor during the management period. Investment management period, recoverable operating expenses, you need to indicate there. The average growth rate, annual growth rate for the expenses, which is usually 3%. So here we do have the operating expenses, we do have the admin fee. We also have all the way to the contract for services. So these are the total expected rates. So this one is what the input section can be able to alter and be able to determine the percentage of expenses. So here we do have the total amount that will be the total annual operating expense amount for the controllable operating expenses. We also have for the utilities on this section, for the non-controllable operating expenses, that section. So the total expenses will be at that much, and that will be the total percentage against the effective gross income for the residential component. Yeah, so those are the key tabs that I do have for this model, and all of them now come back and be able to present their outputs on this investment summary section, which can be used as the dashboard for the model. So that's a rundown of this financial model, and I believe you can be able to find it useful. And in case you need any underwriting assistance for any multifamily development project that has multiple uses, I can be able to use this model and be able to assist you and be able to underwrite your project. Thank you.